Hi again. We've just gone through a considerable amount of material on central banks. I hope by now you appreciate the importance of their decisions on the financial markets. Next, let's look at specific economic indicators and finally, how to trade them.
Much like PMIs, surveys about consumer and business confidence, as well as sentiment, are also a hybrid type of economic indicator. These use anecdotal results from surveys to form a numeric index figure. Also, like PMIs, these surveys tend to be forward-looking, so they're really good leading indicators. For consumer confidence, survey takers track consumers' perceptions of their economic well-being, which determines short-term spending, borrowing, and savings plans. For business conditions, again, surveyors get anecdotal measures of business sentiment as early warning of changes in the economic cycle. Overall, consumer and company attitude surveys about the degree of optimism or pessimism reflect into factors such as individual savings or company expenditures. The last group of economic indicators that I will talk about is broadly defined as housing-related or housing sector figures. As housing forms one of the largest portions of an individual's assets, the outlook for this sector is important as both a leading and coincident indicator. Examples of these sorts of figures start from when construction permits are issued, called building permits, to construction orders and housing starts, through to sales figures and leftover inventory. There are numerous house price indexes as well, the best known in the U.S. being what used to be called the Case-Shiller House Price Index, but is now known as the S&P CoreLogic CS House Price Index. So far, you've heard me talk about the importance of economic releases and how market watchers pay close attention to the myriad of information that's released daily. The next section is the practical part of the course where we connect the dots. So while there's no easy way of knowing how each economic release will impact a certain market, we will try to give you a few examples so that you may get a flavor of how it works. So let's go back to economic releases. Not all economic releases carry the same market weight. Some are more important, like central bank rate decisions and U.S. payrolls, and they'll affect the markets generally. Others are very much asset class specific, say commodities-related production and supply news that may impact a specific commodity. Then, there are economic releases that impact certain duration products, such as Japan's YCC, which tend to impact longer-dated Japanese government bonds. Then there are releases that are related to certain countries or currencies, such as GDP release for Germany, which is unlikely to impact things in the US. Lastly, there are also company-specific releases, but they tend to be less economics-driven and more fundamental to the company's operations or the industry itself. It's also important to understand how misses exceed or fall short of market expectations, but before that, we need to revisit how market expectations are formed. According to Lawrence J. Peter, an economist is an expert who will know tomorrow why the things he predicted yesterday did not happen today. So despite that dismissive description, the market does rely on expectations of economic releases called forecasts. For example, banks hire teams of economists to build models based on historical trends, seasonality, affiliated statistics, to come up with their predictions to share with their own internal traders as well as their best clients. There are also many independent and professional research firms that provide figures to their paid subscribers. Lastly, clients and market makers themselves have their own models and sources for information to give themselves as much of a chance to have an edge as possible. So on this slide, I've attached a screenshot of the Fed Funds target rate forecasts for January, and this screen was taken before the surprise FOMC decision on March the 3rd. So you'll see that the next scheduled FOMC meeting date is still March 18th on the slide. So as you can see on the slide, there were 94 estimates from 77 so-called qualified economists. But you'll note that the forecasts were very tightly centered around the median forecast of 1.75, with very few outliers. Partially, this could be due to the fact that economists constantly refine their forecasts based on the latest data and information from the market, as well as how the market consensus is moving. It could also be due to how well the Fed has telegraphed their future actions to the market. I also personally believe that when there's a great uncertainty to an economic forecast, no one likes to be wrong by themselves. So forecasters move in a herd-like manner with safety in numbers, preferring to be wrong together with most of their peers rather than to be the only one right.